you and I both, we've invested through the real crashes, which are very few and far between. And you know what? Ultimately, those who want to crash, it's like, well, okay, why? Because if you have a crash, are you going to be the one that buys at that time? I remember living through it that people are scared to buy when that happens.
Yeah.
And even the people that were waiting for it are like, oh, well, it's catching a falling knife. Why would we want to catch a falling knife? We'll wait for the knife to keep falling.
Over the last couple of weeks, you have heard me have conversations with folks like Melody Wright and others talking about a 2025 housing bloodbath in single-family homes. Those discussions all orient around the median national home price. But who cares about the national home price? Let's talk about a market, your buy box. And in this case, we are going to talk with a top 1% agent, and we're going to talk about what it would take to have King County, aka Seattle, have a housing crash. Now, this might be unique setup to Seattle, but hey, at the end of the day, any market in the country could crash 10 or 20% if things went the wrong direction. Beth, how you doing?
Hi there. Doing great, Mike. Thanks for having me back. Always fun to explore these different what-if scenarios and look at what could possibly bring about the crash that we hear about so often. I've been hearing about it for, 25 years now. And every once in a while, it's right. So every once in a while, I'm not going to discount that. No. But there are some things that would have to happen, some pretty extra. So for any time there's a crash, I would say the basics are there has to be a significant increase in supply coupled with a drop off in demand. And what would cause that? So when you think about, well, what could cause more inventory to come on? It'd be people who need to sell, people who are moving out, more people moving out of our area, I would say, than moving in. And for demand to drop off, there would have to be uncertainty in our economy, or a significant drop in my area, be a significant drop in tech stock values, because people rely on that largely for a lot of people do rely on that for their down payment or their purchase, or just their general financial health. So if that took a significant hit, and if people felt their jobs were not secure, that's another thing that makes buyers hesitant to jump in and make a large purchase like a house or take out a mortgage.
Yeah.
So I say those things would be the first things that come to mind for that.
Yeah. So let's break them down, because I think you've hit on all three issues, and I want to break them down because I think there are individual things that we could talk about in all three. That's supply, that's demand, and that's confidence. Right. Both confidence from the buyers and also from banks. We can't forget that banks play a big part of this. And again, you've been doing real estate. I'm just going to say 20 plus years. Is that fair?
Yeah. 26 years going on 27.
Yeah. So I've been playing for just about that long. So let's talk about supply first. You and I have been around long enough to see Seattle go through a lot. Right. Seattle today is very different than 26 years ago. But something I think happened, I want to say it was 20 years ago. It might have been 15. I'm sure you'll remember this. It's when Boeing left and moved. I think they moved to Chicago.
Yeah.
Right? When Boeing left the Pacific Northwest and moved to the Midwest. Talk about losing a major employer. Obviously, they haven't left entirely. They still have.
Yeah. So that was a hit, but Boeing is still a major employer in our area. So they still have their manufacturing plants here in north of Seattle in the Everett area, and also in Renton, which is just south of Seattle. So they are still an employer, but the management, a lot of them did leave. So that was, it didn't have the same impact that it did back before my day in the 70s, when there was a famous billboard that said, will the last person leaving Seattle turn out the lights?
Yeah.
I don't know when that was, late 70s, early 80s. It was a famous thing. Some real estate guys put that out there, I found out, which I thought was interesting. But finding a way to seize the moment in some way. But at that point, we weren't as diversified as we are now. So now we have the Microsoft, the Amazons, the you name it, all these other businesses here.
Yeah. Where I was going with that is Boeing is just a clear example. But again, we're just totally paying what if. We're not making any predictions.
Yeah.
I'm just trying to lay out the
Mhm.
steps for a price crash in King County or Seattle. Let's just play for a minute and say for some reason it becomes too expensive to be a tech company. Maybe there's some taxes, like San Francisco put taxes on tech companies, right? If your CEO makes 100x this or that, you got to pay more taxes. Let's just say, there's some government adoption of tax profile that makes Microsoft, Amazon, and any other big tech company go, you know what? We just can't function here. If Amazon and Microsoft and others like them leave, that will be a problem.
That would be nothing short of devastating for our local economy. Absolutely devastating. So if they decided to do that, over regulation, taxing, we even have seen a small bit of that where just within our local area in the city of Seattle, more taxes on businesses within the city of Seattle. They're hopping across the lake.
Yep.
15 minutes away, you just go across the lake and you've got Bellevue, where you can just see all the proliferation of high rises being constantly built over there. You can still have the same workforce, but just right across the lake makes that an appealing thing. But if they left our area altogether, it would be like that 70s, late 70s, early 80s, last person turn off the lights. Like that is the driver for our economy. And if that were to change, we'd be in a lot of hardship.
It would be ugly. I mean, just you couldn't say it any other way. And again, we're not calling for that to happen. I'm sure nobody in Seattle government is that stupid. But hey, they were that stupid in San Francisco, so it can happen.
Let's hope.
Yeah. So that's one thing I was thinking about. Again, if your local government, in your buy box or your city, basically singles out an industry, capital moves, right? Capital has freedom, and in this case, in this example, the big tech would leave. They would take all the jobs with them. Housing would be devastated. It just would. So that's
similarly with. There's a capital gains tax now for super high earners. And so Bezos moved, for example, so there is that I haven't seen any mass exodus at this point, but where we are is there's a tax now that's just for those people. And so you disincentivize that. Well,
a lot of people have left Chicago. Again, just using real examples from across the country. Chicago has put a tax on, I don't know if it was 100 million or $1 billion, but you've seen a lot of wealth leave Chicago and go to Florida. So again, these are all things that can happen. The next one I was thinking about talking to you, again, something we have been through. We have been through you and I went through the .com recession, which was, the whole country wasn't really impacted, but .com was devastating. If we went through a white collar tech recession, maybe AI advances enough where white collar jobs are slashed 20%, right? And again, I'm not only talking accountants, I'm talking engineers, computer scientists, product managers, all these guys at these tech companies making $200,000, $300,000, $400,000, $500,000. If we suddenly saw some kind of white collar recession where unemployment in that sector went to 15 or 20%, that would be a problem because you get a lot of people that need to move. They can't carry their mortgage. You also you lose confidence, kind of to your earlier point, because everybody's on pins and needles. They could get the next layoff notice. Is it fair to say that a deep, dark, and nasty white-collar recession could also be very, very negative for housing in Seattle?
Absolutely. Even the threat of it, I think, can damage the psychology. And I remember in 2001, right around there, was when we had that happen with we had all these crazy startups that just, we're getting all this funding, just blow up overnight.
Gone.
It was kind of humorous, some of the stuff that was happening back then. Not to those who were devastated financially, obviously, but like some of the stuff that was. Anyway, we won't reminisce too much on that. But there was a lot of these companies getting obscure, 18-year-olds getting paid millions of dollars to, I don't know, create these ridiculous websites. Anyway, it didn't turn out well, and there was a correction that needed to happen. And it was bumpy for a while there. I don't remember it lasting. I mean, this is a long time ago, right? About 23 years ago, but I don't remember it lasting a huge amount. It seems like there was a fallout and then it kind of sorted itself out within about a year.
It's about a year. Right?
Yep.
It was
Yeah.
about a year. Yeah.
Yeah. And I remember the stock, thankfully, I didn't have too much in the stock market. I know you did because you talk about that, but stocks tanked for a while there. Real estate was kind of plugging along, but I do remember it definitely pulled back for a while there where people were, market times increased, buyers were more hesitant, sellers had to sell for less or ride it out. And, it seemed like people that had the more traditional white collar jobs still seemed to do okay. It was all this startup frenzy, just craziness that people that worked for those companies, those were the ones that just found themselves unemployed really quickly. And a lot of them moved away and got other jobs. A lot of them never had any business being in that business in the first place, but it seemed like the pros weathered it okay.
Yeah, it was bad. There was about a year of pain, even because, again, I think Seattle and Silicon Valley kind of have similar paths on this. So now let's switch to demand, because I think there's one thing that we need to acknowledge on the demand side. One of the reasons the Silicon Valley, San Jose specifically, and Seattle are doing so well is because of stock prices. There's a lot of AI money, a lot of cloud money, a lot of RSUs, a lot of bonuses, just a lot of people sitting on stock wealth, which many people convert to primary residence or real estate at some point in their career. And that's how you can have people pay $50,000, $60,000, $70,000 over list price in a competitive market. If, not calling for it, but if we head into a bear market, let's call a bear market down 30% total, but if we have tech or big tech down 50%, that is going to dent demand. The wealth effect that works on the upside also works on the downside. And you would have a lot less people converting their now equity that's half into real estate because they will just choose to stay put. Is that fair?
Yes. So we would see fewer sellers and fewer buyers. So if you can imagine that on top of what we're already dealing with, that would be probably new record low transactions, right? So I think that would definitely be something that would it create a crash? Hard to say, but it certainly would be downward pressure on our market.
It certainly would be a transaction crash. It would certainly be a transaction.
For sure. And on the east side, we're more tech centered, so it would be hit harder on our east side. So we're kind of segmented into two halves of the county. So the Seattle side and then the east side. And the east side tends to be higher prices, more tech, all of that. Lower supply too right now, lower inventory. So if we increase that, and I think a lot of sellers, if they just couldn't get the money they could get for their house, they probably wouldn't sell unless they were in really a bad financial position. I do not see a wave of foreclosures happening just because of the sheer amount of equity we have here. People don't seem to really understand that buyers are not and owners are not over leveraged. We're not seeing that we saw back in 2008-ish and all those crazy loans. People are putting a lot of money down. There still are a lot of cash buyers out there. People that rolled their equity from their last house into the new house, and they're nowhere near being upside down. So, and for someone to just let their credit go and slash and burn, like it takes true desperation to make that happen. It takes people with no other options, and people around here, they have options, and their house has equity.
Yeah. Again, we're just playing in the King County area. Every market is different, but one of the things I read over the weekend, Housing Wire, it might have been yesterday, that the crash bros don't understand is you don't go from employed to you go from employed to unemployed in a snap of a fingers, but you don't go from comfortable to desperate in a snap of fingers, especially in markets like Seattle or Silicon Valley, because you will get a severance package. You have RSUs, you have 401ks, you have all of these things. So the desperation will build, right? But it takes months and potentially years for any of that to really, really hit the market. So again,
it does. Yeah. People aren't going to, people have to be out of options for them to go to that, to go from financially stable and affluent even to selling their house as a short sale.
Right.
Which even if we went down 20%, very few people would be doing a short sale.
Right.
So what led to that short sale wave before was people were purchasing that didn't qualify for, they were purchasing with, I don't know, 105% loan to value. And then the market goes down, they have no skin in the game and they can't afford the payment. And then they need to, it's a combination. The stock market went down, all these things happen all at once, like the dominoes falling, and then people are, and then the market value goes down and people are like, well, why should I be paying on this house that I owe more than it's worth?
It takes so much time to get there. Yeah.
Years.
The one thing,
it was very long. It was many, I don't know, what is it? 5 years peak to trough? Something like that.
Correct. 5 years in a row of negative. So
and then it took about another 5 years to get back up to where we were. So more or less.
Yeah, one of the things that a lot of the crash pros don't understand is for values to degrade, X, like what we talked about, mass employers, max tax overreach, those things that cause instant reaction. It's a lot slower than people imagine. I do think the other thing about a negative wealth effect, I think to your point, is it will definitely impact transactions more than price. Because again, I've worked in tech for 25 years and I've been through environments where, hey, you're worth, $1.5 million in your RSUs and then you're worth 500.
Yeah.
What you always remember is the 1.5 and you just wait, right? It's just human nature. There's like, oh, it'll come back. Yeah. Maybe it does, maybe it doesn't. But again, it's not really something that will cause you to become a forced seller. The other thing I think we should talk about here is banks. There was an environment, really it impacted investors more than homeowners. But there was a time where banks basically didn't want to play, and they said, "Hey, you can't have any more than 4 loans." I don't know what lenders could do. I don't know. Maybe lenders take mortgage rates to 9-10% because inflation kicks off again. I mean, there's at some point where rates get so high that maybe prices have to fall. I don't know. Maybe let's pretend for a moment rates are 10%. Obviously, it hits
rates are 10%. Everything would freeze up. Look what happened in summer of 2022, when rates just started skyrocketing. Everybody just went, whoa, hold the brakes. And people that were shopping at, let's say, high 6s now, and then it goes to 10. Well, yeah, of course, especially if you're an investor, it's hard enough to make something cash flow at this 7-8%. If you go to 10, then it's going to be no go. So unless prices
exactly. So again, I think if I just play this out, let's just say by the end of Q2 2025, rates are 10%. The short-term reaction, short-term being Q3, Q4, is just no transactions happen.
Yeah.
You don't really even have any price fluctuations, at least not meaningfully. But I'm willing to bet if rates stayed at 10% long enough, that eventually the must sell would increase enough where we would see price collapse. So that's probably in 2026, but not 25.
It would take a while for that to play out, just kind of like we saw it happen earlier a while ago, where everything froze up a little bit. We didn't see prices come down, but we did see there was an adjustment period that happened after a period of time. And in our area, prices did go down a little bit initially, and then they did rebound over time. So the other thing about banks too is that sometimes, especially for investors or self-employed people like me, they will they won't necessarily say we won't give you the loan. They'll just make it a nightmare to they'll come up with enough conditions to try to scare you out of the deal.
Right.
So I am starting to see that kind of in certain isolated cases. So have a portfolio lender. It wasn't my client. I was working for the seller, but I think they just didn't like this buyer. And so they didn't want to say no, but they just made it increasingly absurd, the things they were asking for. It did close, thank goodness, but it took some extreme dedication.
I don't know if this happens a lot in your world, but I've heard about some buyers, some Wall Street money closing up, or I shouldn't say closing up shop, not buying DSCR loans. In your world, do you have a guesstimate what's a traditional, conventional mortgage versus DSCR? Do you have any idea, or you don't really look at those details?
Or how many are DSCR versus conventional? Well, the vast majority of ours are going to be conventional.
Or jumbo.
But I've had some buyers recently use the DSCR, and it's not that many, honestly.
Yeah, so
not in our market.
if DSCR disappeared, it'd be, it wouldn't be an event.
I mean, as an investor myself, I think like, well, okay, I was hoping to do a refi next year on a project I'm working on when it's complete. I wonder what that will mean for me if that DSCR option is off the table, what options remain. It's just another challenge for investors. I don't think it would lead to any crash or anything like that, but it definitely will impact investors. The thing about these things is they tend to last for a little while, and then somebody will come in and fill the need. So it's just a matter of that one left. Somebody else is right now trying to hatch a plan to take that market share.
Exactly.
It might be a little bit of a lag while they're figuring it out, but they will. So somebody will fill that gap.
Yeah. So, those are the things that I came prepared today. I know I sprung this on you very last minute because we don't, plan or prep for these. But when you think about your 26 years in the business, you think about what's unique to the Seattle King County market. Are there any other things that could lead to supply shocks, demand shocks that could lead to price degradation in 25 or 26?
I don't know, short of natural disaster or something like that. It's like earthquake hits.
Yeah.
That would be interesting, but that would hit the supply and the demand
I'm glad you brought that up because I lived through, I think they called it Loma Prieta, the one that happened during the World Series between San Francisco and the Oakland A's. And again, I have firsthand experience, right? So I was a teenager, but old enough to remember what was going on. There was probably a 6-month window where everybody was scared the big one was coming. And when was that? That must have been 87. So I was 15 or 16 years old. And I remember visually seeing more house sales, like for sale signs.
Yeah.
As a teenager going, wow, this is weird.
Interesting.
Now, again, that it lasted only about 6 months because then, we haven't had one of those, knock on wood, since. But you're absolutely right. I could only, if that were to, heaven forbid, happen in Seattle, which to my knowledge is really not earthquake. You guys don't expect them. We kind of expect them in the Bay Area.
We expect them here. We're in it. We have a fault line. We have fault lines going through there. I have earthquake insurance on several of my properties in the area. So it's a thing. It's a thing. We just haven't not as much as Southern not as much as California, your area south, but we do. It is a thing. We haven't had any big ones since, knock on wood. But I think it was sometime in 2001-ish. We did have one. It wasn't. I think it was a 6 or 7, something like that. Yeah. It didn't create a huge amount of damage.
Yeah. So again, you're absolutely right. Again, anytime you change consumer expectations or psychology quickly, like a potential 8.0 earthquake, again, not calling for it, we're just playing devil's advocate here. I do think that would cause many people to go, I'm out of here. I'm going to Texas or, wherever.
It kind of reminds me of, so my frame of reference was we invested, we bought a couple of houses in New Orleans right before, 9 months before Hurricane Katrina. And it was not in the flood zone, thank you very much, but I got the flood insurance anyway because the Mississippi River was right there. I just don't know about this, so we got it. Had family down there. We bought these beautiful Victorians and rehabbed them, and it was so great. And then that hurricane hit and flooded them out with 4 feet of water. And I haven't not invested out of state since then, I'll have you know. But but thank goodness for that flood insurance, where I think was $150 a year on each property because it was outside the flood zone, was the best $150 I ever spent. And we navigated through all that, and I learned a lot. But one of the things I learned was, when you take away a large amount of a metropolitan area's habitable housing, what's left becomes very, very valuable. Like what's not damaged gets very, very valuable, because you've got not only the people that were displaced that need to stay someplace while they're getting their insurance sorted out, you've got all the people flooding in to do all these repairs and everything. So and you also have a lot of people leaving too. So it's an interesting, weird dynamic. I remember values went up, but then they went down after a while too. So, but yeah, if you want to really throw a wrench in the works, some people have got this wildfire, not so much here, but if there's a wildfire concern or earthquakes, hurricanes. I mean, kind of look what's happened in Florida. I mean, I don't really know that market super well, but from what I've heard, those areas that are frequently hit, I mean, I feel for those folks. It's tough out there. And for some, their market's really suffering. So I think you throw some wild card in there like that, that could definitely impact values.
Yeah. So at the end of the day, again, we just wanted to have a what if scenario, what could happen. We're not, neither one of us are calling for price crashes in Seattle or King County. We just wanted to acknowledge there are outside forces that could certainly disrupt and crash real estate values. Nothing appears to be set up at the moment, but I think this was a fun, riff.
It is. It's a fun what if, and I like to throw these little scenarios around and kind of just explore them a little bit. But one thing I want to mention to people is, like, you and I both, we've invested through those, the real crashes, which are very few and far between. And you know what? Ultimately, those who want to crash, it's like, well, okay, why? Because if you have a crash, are you going to be the one that buys at that time? I remember living through it, that people are scared to buy when that happens. Yeah. And even the people that were waiting for it are like, oh, well, it's catching a falling knife. Why would we want to catch a falling knife? We'll wait for the knife to keep falling. And then people there's still the reasons to not buy. And if you just ride it out like I did and you did, think about what values were in 2001, for example, versus today. I can tell you in the Seattle area, I think the median home price in Seattle was somewhere around, I don't know, 275 or something, maybe in 2001. I could be wrong, going off my real life memories of that time. But and what is it now? Around $1 million in Seattle, 1.6 on the east side. So should we have just not bought or what? So I would say just make your plan and think about the greater why. Like, why is it that you want to crash, and what would you really do? I think those who are waiting for the crash bros, whoever you are out there, like, what are you expecting to do when it does crash? Will you be ready to buy, and will you buy? That's the bigger question.
No, I can guarantee you the loudest people calling for a crash, they'll never buy. Yeah. They will be so scared of putting their pennies to work.
Looking for justification to do nothing. Yeah. And if you want to validate yourself and do nothing, then be my guest. It's really fine with me.
Yeah.
And if a crash happens, I will persevere, and so will you, just like we always have. It's just, you have to expect that corrections rarely will a crash happen. You protect your base, and you stay solid, and you find ways to push through, and then you come out better and stronger on the other side. So
love that. Beth, you are amazing. Obviously, the team could go to BethTraversogroup.com if they're interested in King County, but I'll do you one better. If you are anywhere in the country and you want to meet or network with a top 1% agent, how do you do that? You reach out to a top 1% agent.
Yes.
Call Beth. You reach out to Beth. So
happy to make introductions, chat with folks. Sorry, me to cut in there. But if people reach out to me, I love to connect with people from the One Rental at a Time community. I'm out there on every platform. I'm in the school group. You can reach out to me at BethTraversogroup.com, and happy to connect with people all over.
Awesome, Beth. You're amazing. Thank you for all you do, and happy holidays.
Thank you. You too.